Take a single $10,000 investment and split it across Fidelity's 3 best index funds. Even with the same ingredients, you can create 2 wildly different financial outcomes by changing how you divide the money. 30 years is a long timeline. You'll likely see decades where the market stagnates, years where it booms, and periods where the U.S. economy falls behind the rest of the world. Because no single asset handles all those scenarios, most portfolios divide the work into 3 distinct jobs. First, generating income. Second, capturing growth, and maintaining international exposure. For the income job, we look at FDDV, the Fidelity High Dividend ETF. Beginners often assume dividend funds only hold sleepy utility companies and slow-moving energy stocks, but that overlooks how the market has shifted. Look at the actual holdings. The top of this fund is dominated by companies like Apple and Microsoft. These tech innovators have reached a size where even a small slice of their profits equals a massive dividend payout. These giants spent their early years aggressively expanding. Decades later, they are established monopolies that generate billions in excess cash, which they now pay directly to their shareholders. For the growth job, we use FNCMX. This fund tracks the entire NASDAQ composite. It is heavily weighted toward technology and innovation, and its goal is aggressive share price appreciation. Finally, a resilient portfolio needs exposure outside the United States. FTIHX is the Total International Fund. It holds thousands of stocks across developed and emerging markets, providing a floor for the portfolio if the American economy hits a slump. Picking these 3 funds is just the first step. The actual results over 30 years come down to the specific weight you give to each one. The exact same $10,000 across those exact same 3 funds creates 2 radically different 30-year outcomes based solely on the chosen percentages. Path A is the accumulator route. This strategy is optimized strictly to produce the largest possible final account balance at the end of the timeline. Path B is the cash flow route. This strategy is optimized to generate a permanent monthly paycheck without requiring you to touch the original principal. This chart plots those 2 goals. As you can see, they sit at opposite ends of the spectrum. Maximizing total growth and maximizing monthly cash flow are 2 fundamentally different objectives. You cannot have both extremes at once. Choosing to prioritize one metric requires a specific sacrifice in the other. In the dividend tilt, 50% goes to the international fund, 30% to the dividend fund, and 20% to growth. FTIHX has a 16.98% dividend growth rate, the engine compounding your income the fastest. The 30% in the dividend fund provides immediate yield today, while the 20% in the NASDAQ fund keeps the overall account from stalling. Run these wheats for 30 years and your $10,000 reaches a projected terminal balance of $416,613. While that account growth is steady, the real headline is the income. By year 30, this portfolio is projected to pay you $2,048 every single month for the rest of your life. This happens because of dividend reinvestment. For 3 decades, every payout bought more shares, which then paid more dividends. That loop generates nearly 40% of this portfolio's total growth. This portfolio sacrifices a larger total net worth to provide a reliable $24,000 a year paycheck that arrives regardless of market conditions. For the growth tilt, we put 70% into the NASDAQ, 20% into dividends, and 10% into international. This allocation focuses on the NASDAQ's historical 17.45% annual price appreciation, designed to capture maximum capital growth. Dividends are deprioritized, and international exposure becomes a minor safety hedge rather than a core position. After 30 years, the results are much larger on paper. This growth-heavy weighting is projected to reach a terminal balance of $699,558. The trade-off shows up in the monthly payout. While you have nearly $700,000, the organic income produced by these shares is only $98 a month. Almost 98% of the growth in this portfolio comes from share prices going up. This is paper wealth, not cash hitting your bank account every month. The growth strategy creates a significantly larger account, but it leaves you entirely reliant on selling your shares to generate cash in retirement. A larger account often suggests a larger income. If you apply standard retirement math to that $699,000 balance, the growth portfolio appears to be the better income play. This is based on the 4% rule. the financial guideline that suggests you can safely withdraw 4% of your total portfolio each year without running out of money. Following that rule, the growth account yields $2,332 a month. However, the execution is different. The dividend investor never sells a share for their cash. The growth investor must actively liquidate their principal to pay themselves. Selling shares works well in a bull market, but if a severe crash occurs when you retire, you must sell while your account value plummets. This is sequence of returns risk. In a market drop, Path A requires no action. Dividends keep paying. On Path B, you must sell double the shares to cover bills. Selling at a loss permanently shrinks your account, leaving fewer shares to catch the recovery. The mathematical advantage of the growth strategy assumes consistent market conditions. The dividend strategy accepts a lower final balance to eliminate the risk of bad timing. Choosing between these strategies requires looking past the final numbers and considering how you will actually react when the market drops. You have to weigh the cost of peace of mind. Is avoiding the stress of selling shares worth sacrificing nearly $280,000 in potential gains? This behavioral framework helps you map your goals to the correct Fidelity strategy. If you are comfortable with market volatility, understand mechanical withdrawal strategies, and prioritize maximum net worth, the growth tilt is your correct path. This choice only works if you have the discipline required to execute stock sell-offs during a recession without panicking. If your primary goal is simple, hands-off income, and you want to avoid the stress of selling shares, the dividend tilt is the better fit. You strategically accept a smaller terminal balance as a premium. In exchange, you get the security of never needing to touch your principal. Even the highest historical return is useless if your psychology causes you to abandon the strategy during a market downturn. The most effective strategy is the one you can commit to for 30 uninterrupted years, regardless of how the numbers look on a spreadsheet.